Liberation Day. It was supposed to mark America's economic independence. Instead, it kicked off a summer of chaos that ended with your shoes costing 40% more and American manufacturers drowning in their own government's red tape. 3 months of threats and negotiations produced exactly what you'd expect. The entire world quietly rerouting supply chains to avoid American ports. Today, we're digging into how the trade war spiraled out of control, who's getting rich off of the wreckage, and why September might be even worse. My name is Nick, and you're watching The Coin Bureau. First things first, none of this is financial advice. I'm just someone on the internet tracking how Liberation Day turned into Liquidation Summer. Do your own research, especially before making any trades based on some YouTube videos. The tariff rates alone can change faster than we can actually edit. And if you want more information and interesting content like this, don't forget to smash that like button and subscribe to the channel and ping that bell for good measure as well. Now, this year's tariff saga began with Trump's campaign promises to restore American manufacturing through protective trade barriers. The logic seemed straightforward. Make foreign goods more expensive and domestic production becomes competitive yet again. Since April 2nd, what Trump christened Liberation Day, we've been waiting for this to play out. But his manufacturing miracle, it hasn't shown up yet. Now, the Liberation Day announcement represented the most aggressive trade action in nearly a century. Trump unveiled his tariff spreadsheet with a theatrical flair, showing threatened rates ranging from 11% to 50% on dozens of trading partners. The highest rates targeted a mix of strategic adversaries and geopolitical outliers. 41% on Syria, 40% on Laos and Myanmar, and 39% on Switzerland? Switzerland? What followed was a 90-day negotiation period that felt more like a hostage situation. Countries scrambled to cut deals while markets gyrated on every single rumor. The whole spectacle culminated in the July 31st executive order that locked in the final rates and triggered an immediate market meltdown. To understand why, we need to go way back to April 2nd. The April 2nd announcement sent immediate shockwaves throughout global markets. Trump's tariff poster became the most expensive piece of cardboard in history as markets went into freefall. The initial list showed America imposing an average tariff rate of 27%, more than 10 times higher than the 2024 average of 2.5%. The 90-day grace period Trump granted wasn't so much mercy as psychological warfare. Countries had until July to negotiate exemptions or face economic exile. Vietnam managed to secure talks for possible removal, but others weren't so lucky. The entire period demonstrated how uncertainty can be more damaging than the policy itself. The absurdity peaked with Trump's reciprocal tariff framework. As trade experts have noted, calling these reciprocal was a bit of a misnomer. The rates weren't based on what other countries were charging America. They were calculated by dividing trade deficits by exports. It's kind of like calculating your restaurant tip based on how hungry you were before you started eating. Switzerland, with average tariff rates under 1%, faced American rates of 39% because they dared to run a trade surplus. The maths punished efficient exporters and rewarded inefficient ones. Economists struggle to explain how making trade more expensive for everyone would boost prosperity because the maths, it wasn't mathing. So, after 3 months of threats and negotiations, the final executive order dropped on July 31st. The definitive tariff schedule confirmed everyone's worst fears. It was trade policy by spreadsheet, maintaining crushing rates on major trading partners while offering token reductions to countries that had prostrated themselves during negotiations. The timing couldn't have been worse. The order landed just as markets were digesting disappointing earnings and weak economic data. August 1st saw sharp sell-offs. The S&P 500 dropped 1.6%, while the Nasdaq fell 2.2%, marking the worst day for markets in months. But the stock market sell-off was just the appetizer. The currency markets went haywire as the dollar paradoxically strengthened despite America declaring economic war on its trading partners. Treasury yields fell sharply as investors sought safe haven assets, and commodity markets whipsawed as traders tried to figure out which supply chains would survive. Real economy impacts manifested immediately. Ford and GM, already struggling with the EV transition, watched their input costs explode overnight. Apple warned of a $1.1 billion impact in the current quarter alone. The National Association of Manufacturers reported that 89% of members faced increase in costs, not from foreign competition, but from their own government's protection. The earnings calls following July 31st are revealing the damage in corporate speak. GM reported a $1.1 billion hit from tariffs in Q2, contributing to profits falling 32 to 35%. CEO Mary Barra tried to sound optimistic about, quote, adapting to new trade realities, but analysts weren't buying it. Small manufacturers are facing existential threats rather than quarterly disappointments. Unlike corporate giants, they can't absorb the sudden shock of a 50% tariff on essential inputs like foreign steel. For firms with slim profit margins, these tariffs function as a death sentence delivered by their own government. And companies aren't bringing jobs back to America. They're actually fleeing American tariffs by moving production anywhere else. The agricultural sector has discovered that export markets, once lost, don't return very easily. China has already replaced American soybeans with Brazilian supplies, and the European Union is accelerating trade deals with South American countries. American farmers are finding themselves locked out of markets they'd spent decades cultivating, while simultaneously paying more for fertilizer and equipment. The promised agricultural bailouts remain trapped in congressional gridlock. Farm state Republicans face an impossible choice: support Trump's tariffs and anger constituents, or oppose them and face primary challenges. Most are choosing silence, hoping the problem will just go away by 2026. Of course, many of the manufacturers crying about tariffs today are often the same ones who spent decades shipping jobs to China. There's a certain poetic justice in watching companies that hollowed out American industry for quarterly earnings now getting crushed by the consequences of their own offshoring addiction. But the executives who made those decisions are lounging on their yachts. Today's factory workers and small manufacturers, the ones who stayed and tried to compete, are the ones who are bleeding out. The tariffs arrived 30 years too late to punish the actual culprits. A serious industrial policy would rebuild domestic capacity through targeted investment and training. Instead, we got a consumption tax disguised as patriotism. The tariffs, they don't reverse deindustrialization. They actually accelerate it by making the remaining American factories uncompetitive. It's like chemotherapy that kills the patient faster than the cancer. But while businesses and farmers bleed, the Treasury is collecting record tariff revenue. In the first half of 2025 alone, the government collected over $87 billion in tariff revenue, more than in all of 2024. June's haul of $26.6 billion was nearly 4 times January's intake. And this gives the administration its favorite talking points. Trump declared on social media that tariffs were making America, quote, great and rich again, claiming that just 1 year ago, America was, quote, a dead country, but was now the, quote, hottest country anywhere in the world. The base loved it. But the fact that it was Americans who were paying those billions was less advertised. Research on the initial tariff rounds revealed where exactly that money was coming from. Chinese exporters lowered their pre-tariff prices by a mere 0.7%. The other 99.3% fell on the American importers. The Treasury's windfall comes entirely from American businesses, dutifully passed on to American consumers. The average American household is facing $2,400 in additional costs from Trump's tariffs in 2025. Shoes and leather goods have jumped 40% and apparel by 38%. The back-to-school shopping season has become a financial nightmare for families already stretched very thin. June's CPI came in at 2.7%, still within the Fed's comfort zone, but forward-looking indicators are screaming trouble. Import prices surged, producer prices accelerated, and companies are warning of coming price increases as they work through pre-tariff inventory. Housing costs, meanwhile, have exploded as Canadian lumber tariffs add thousands to new home prices. First-time buyers, already priced out of the current market, are giving up entirely as the American dream of home ownership retreats further into fantasy. Consumer behavior is adapting predictably. Walmart reports customers trading down to cheaper alternatives. Dollar store traffic is surging as middle-class families join traditional low-income shoppers. The K-shaped recovery economists warned about has become undeniable reality. The Fed finds itself trapped between inflation and recession. Raising rates to combat tariff-induced price increases would crush an already weakening economy. Keeping rates steady means accepting higher inflation. The transitory debate has returned with a vengeance, except this time the inflation is policy-induced and seemingly permanent. Computer prices rose 1.4% in June, a seemingly modest increase that masks the broader technology inflation building in the pipeline. Semiconductors, already constrained by supply chain disruptions, are facing new price pressures from tariffs on components. Tech giants like Apple and Microsoft are warning of significant margin compression, threatening both innovation budgets and consumer pricing. Universities and research labs are reconsidering international partnerships that had thrived for decades, suddenly finding collaboration politically radioactive. Now, Beijing's reaction to all of this shows long-term thinking versus Washington's short-term chaos. Rather than engage in tit-for-tat escalation, China is accelerating its dual circulation strategy, building domestic consumption while maintaining selective international engagement. Beijing has its own leverage. The memory of how it used antitrust law to bring Qualcomm to heel serves as a reminder for Silicon Valley. The possibility that Beijing could crack down on patent enforcement has become an existential threat for tech firms reliant on the Chinese market. BRICS expansion talks have gained sudden momentum. Indonesia, Nigeria, and Thailand are expressing interest in joining a bloc that increasingly looks like a life raft for countries caught in America's crossfire. The de-dollarization discussions that had been mostly theoretical are gaining practical urgency. Chinese manufacturers are adapting rapidly. They're establishing operations in Vietnam, Mexico, and Malaysia to circumvent tariffs and selling directly to American consumers through social commerce platforms, all while maintaining market access as Washington fights yesterday's war with tomorrow's economy. Elsewhere, India finds itself in a geopolitical vice. The Trump administration's tariffs are explicitly linked to India's role in BRICS, with the president publicly calling India a, quote, dead economy and citing its membership as justification for the penalties. What makes the punishment particularly vicious, though, is its comprehensiveness. Other countries negotiating with Washington managed to carve out exemptions for critical goods, pharmaceuticals, medical devices, electronics. India got nothing, zero product-level exemptions, even for medicines that Americans rely on. And this goes beyond trade policy into a sort of diplomatic mugging. The message is clear. Play ball on Russia or watch your economy implode. The democracy Washington claims to champion is being economically waterboarded for maintaining strategic autonomy. The policy has backfired predictably. America's attempt to isolate China is instead creating a coalition of the isolated, with India, long courted as a counterweight to China, now being punished for its membership of a bloc where it actively wants to check China's dominance. Meanwhile, India's IT sector, which exports $194 billion in services annually, is watching nervously as American companies pull back on spending. The sector that had thrived on globalization is suddenly facing the prospect of fragmentation, with major outsourcing contracts under review and new deals frozen. But while Main Street bleeds, Wall Street is finding ways to profit from the chaos. Unpredictable policy shifts and tweet-driven market swings create volatility that high-frequency trading desks feast on. When every presidential tweet can move markets, algorithms are having a field day. Private equity firms are playing on easy mode, waiting for distressed businesses to tap out. As tariffs make input costs unaffordable, companies struggle with cash flow, and PE firms swoop in with rescue financing that strips assets and loads them with debt. Policy failure is great news for the vultures of private equity. The contrast in corporate earnings tells the story. Financial services thrive on volatility, while manufacturers warn of catastrophe. The real economy and the financial economy diverge further, with tariffs accelerating the hollowing out of American industry. Meanwhile, the dollar's weaponization is motivating de-dollarization efforts as central banks reassess reserve strategies. Countries that tolerated dollar dominance as a necessary evil are beginning to see it as an unnecessary risk. Europe, for one, isn't rolling over. After months of threats that saw potential tariffs climb to 30%, Brussels negotiated a cap at 15%, but they kept their biggest gun holstered. The EU's anti-coercion instrument, the trade bazooka, gives them powers that make tariffs look quaint. We're talking about banning American companies from bidding on European government contracts worth hundreds of billions of dollars, blocking US investment in strategic sectors, even targeted import and export bans. The instrument was designed after Trump's first term to counter any economic bullying. The 15% deal papers over this powder keg. European steel and aluminium still face 50% tariffs, and French President Emmanuel Macron is calling the agreement, quote, unbalanced. If Brussels decides Washington is using tariffs for political coercion, they could pull the trigger. The transatlantic relationship would go from strained to severed. While BRICS Pay remains more PowerPoint than payment rail, existing alternatives are scaling. China's cross-border interbank payment system was processing over $90 billion daily by 2024. And these aren't yet existential threats to dollar hegemony, but the direction of travel is unmistakable. Traditional US allies are building contingency plans. Canada is exploring deeper Commonwealth ties. Mexico is strengthening regional partnerships. Even close allies are pursuing agreements that hedge against American unpredictability. The legal challenges to Trump's tariffs regime have been mounting since day one. The entire structure rests on the International Emergency Economic Powers Act, or IEEPA. The administration declared the U.S. trade deficit a national emergency and claimed authority to bypass Congress. IEEPA was created in 1977 to restrict presidential power, not expand it. Congress passed it after discovering America had been in a continuous state of emergency for 40 years under various wartime laws, giving presidents a blank check. IEEPA was meant to end that practice by requiring genuine emergencies and regular congressional review. Federal appeals court hearings have exposed the novelty of this interpretation. One judge observed that, quote, IEEPA doesn't even mention the word tariffs anywhere. The administration's lawyer conceded that, quote, no president has ever read IEEPA this way. A lower court already ruled Trump exceeded his powers. The case is now heading to the Supreme Court, where justices will decide whether presidents can rewrite trade policy by declaring emergencies. As of early August, the real economic impacts of Trump's tariffs are beginning to manifest in the US. The manufacturing PMI has registered 48%, firmly in contraction territory. Services are struggling to stay above 50. Consumer confidence is cratering as families feel the squeeze. Corporate guidance is universally disappointing, as CEOs have stopped pretending optimism is justified. Capital expenditure plans are being slashed. The hiring freeze that began in tech is spreading across other industries. Congressional Republicans, facing brutal 2026 midterms, are beginning to distance themselves from tariff policies without criticizing Trump. Democrats offer complaints, but no coherent alternative. The bipartisan consensus on confronting China remains intact, even as methods prove self-destructive. The Port of Los Angeles is warning of disruptions. While they'd managed the initial surge without a single vessel backed up, the July 31st order changed everything. Importers racing to beat increases are creating demand spikes that overwhelm infrastructure. The paperwork burden is meanwhile reaching epic proportions. Tariff classifications are changing by executive tweet. Customs officials are struggling with constantly revised guidance. Every shipment is becoming a compliance nightmare. The chaos of August 1st was just the warm-up act. Trump has announced plans to raise the baseline tariff from 10 to 15 to 20%, with September bringing secondary tariffs of 40% on any country helping others dodging American duties. The administration is investigating pharmaceuticals, semiconductors, and copper for targeted restrictions. Every sector keeping modern life functional is under review. Compliance departments are hiring faster than tech companies are firing. At least there's good news for some sectors, I guess. Penn Wharton is projecting $5.2 trillion in tariff revenue over 10 years. Yale estimates $2.7 trillion from 2026 to 2035. That's trillions of dollars flowing from American wallets to Treasury coffers, repackaged as patriotic duty. Financial markets are pricing in permanent uncertainty. Credit spreads are widening, yield curves inverting, the dollar's apparent strength masks reserve managers quietly diversifying. Smart money is positioning for regime change, political or economic, whichever comes first. Private equity is already measuring distressed manufacturing for coffins while preparing resurrection financing. Smoot-Hawley parallels are impossible to ignore. Those tariffs of almost a century ago didn't cause the Great Depression, but guaranteed its global spread. Modern supply chains make that look quaint. When just-in-time meets trade barriers, failures cascade at fiber optic speed. So here's the first phase scorecard. 89% of manufacturers are facing higher costs. Average households are down $2,400. Agricultural exports are in freefall. Manufacturing jobs disappearing faster than pre-tariff inventory. Global payment systems quietly building alternatives to the dollar. But surely the next round of tariffs will fix everything. I mean, they always do, right? Okay, if you enjoyed this trade war update, then you'll enjoy our latest video on the BRICS, and that's right over here. A spoiler alert, de-dollarization doesn't need a unified BRICS currency to play out. And if you're not subscribed to the channel yet, you can do that right over here. This is Nick signing off. Thank you guys very much for watching, and I'll see you in the next video.